Hello guys, so in this session we will be solving some questions on marginal and absorption costing. So I think when it comes to marginal and absorption costing, usually you are not going to get it as you are seeing here in most questions, but what you are going to be getting is that it will be mixed up as part of a full question. Okay, but here we will be solving marginal and absorption costing questions just to get a hang of it. Okay, so we look at this question. So the following information has been extracted from the records of a company. So we have their information per unit, we have their information per month, and then we have other information. It says there was no opening stock at the start of January, and the budget forecast that production would equal sales at 1,000 units per month, and the company uses a blanket rate of planned output as the absorption rate. So that means their overhead absorption rate is on the units produced, and they gave information per the first quarter for each month. And the requirement is to prepare profit statement in absorption costing, profit statement in marginal costing, and see a reconciliation of profit. So what I do first when it comes to absorption and marginal costing questions is first to determine the cost per unit, right? I need production cost. So I want the full production cost, right? Remember, when it comes to stock valuation, we always use the full production cost per unit, right? For absorption costing, okay, then we use it to value the stock. Okay, so if you like, you wouldn't start with the full production cost, but to get the unit of stock available, right? So stock movement. So sometimes I decide to find the stock movement, the statement of stock movement first. Okay, that's what I usually do in most questions. So my stock movement in units, right? So I say, okay, were there any opening stock? When you look at the question, they said there was no opening stocks on nil, but were there any production during the period? How much did they produce? And once you read the question, it says they produced 1,000 units, not so, and they sold 1,000 units in January. So production was 1,000. So if you have opening stock of nothing, then you produce 1,000 extra. It means that the goods available for sale will be worth 1,000, not so. Okay, since it's worth 1,000, how many units were sold? Sales units. It also says what 1,000 units were actually sold. So it means that there will not be any closing stock. Okay, and you remember from our previous meeting that we said where there's no opening and closing stock, profit from absorption and marginal costing become the same. So this was January, we can create February here, and we can create March here. Okay, so there was no closing stock, so it means that in February opening stock still becomes nil because this stock becomes the opening stock here. Then production, when you look here from what we have here, it seems production and sales have been given in February as production of 1,100 units. So it means we still have 1,100 units available, and then we only sold 800. So if we sold 800, it means how many units remain? It means we have 300 units remaining as our closing stock, which will now become the opening stock for the next month. So opening stock now becomes 300, and then we produce 900. Now, so that gives us 1,200 available for sale, but we sold 1,200 units, meaning we have no closing stock in the month of March. So once you've been able to determine your stock movement, the next thing is to find your production cost per unit. So production cost per unit, because it is this production cost per unit that you are going to use to value the stock. So the production cost per unit, remember that under absorption costing we use the full cost, and then under marginal costing we use the variable cost. So what I need is that to get full cost I need my OAR, and we know that my OAR is my total budgeted overheads over my total budgeted activity basis or level of activity. And in this question, they are telling us that our level of activity is planned output, okay, planned units produced. Okay, that has been given. So in that case, our total budgeted fixed overhead, which they've given us, we can see from here, production overhead was 2,500. So this was total budgeted fixed overhead 2,500. But then the planned output was 1,000 units per month. So this is 1,000 units per month. So that means we end up getting 2 cedis 50 pesos per unit as our OAR. You see, now it was units, not hours, as we have been seeing from previous questions. So now that we have our production cost per our overhead absorption rate, now we need our production cost per unit. Okay, so our production cost per unit. So first of all, let's get our variable cost. So our variable cost, I think we had direct material cost. So we have direct material being 2 cedis. We have direct labor. We have direct labor being 1 cedi. We have variable overhead, variable production overhead being 1.2. These were the only variable cost of production. The other one is selling cost. It means it has to do with selling and admin cost, so it has nothing to do with production. So this one, when we add up with 2 plus 1, 2.2, that gives us 4.2. And this 4.2 is the variable production cost, right? Or the marginal cost of production. Variable cost, production cost per unit. Now, this is what we use to value stock in marginal costing. So this one will be used for marginal costing. Then we now add our fixed cost per unit, right? So our fixed cost of production per unit, or our fixed production overhead per unit. And remember, this is what we use the OAR to find. And that was 2 cedis 50 pesos per unit. Now we add up, and we have 4.2 plus 2 cedis 50 pesos. That gives us 6 cedis 70 pesos per unit. And now, because this is now our full production cost, we use that full production cost to value absorption cost and profit, and then stock. So once you have been able to get our production cost, the next thing is to now prepare the statement, because we need this. But we need to check if there was any under or over absorption for absorption costing, just like we did the last time. So how do we do under or over absorption? That is what we need. So to get under or over absorption, we need to check based on what we have, right? Our overhead absorbed against our actual overhead. So I'm going to do January, going to do February, I'm going to do March, right? So let's get our overhead absorbed, and we know overhead absorbed is actually our OAR. Our actual overhead absorbed is actually our OAR times our actual production, right? And since our OAR was not in hours but units, we multiply by the actual units produced. So in that case, when we take January, our overhead absorbed would be somewhat our OAR, which was 2 cedis 50 pesos per unit, times actual units produced during January was 1,000, right? So that means this one should give us 2,500 as our overhead absorbed actual unit. When we go to February, let me make it 2 cedi 50 by 1,000 so that I can erase this one. When we go to February, I believe the overhead absorbed was, our overhead is still 2 cedi 50 pesos, but we produced 1,100 units during that period. So 2 cedi 50 by 1,100, that's 2,750. Then have March where overhead absorbed is still 2 cedis 50 pesos, but we produce 900 units, so 250 by 900 units, and that gives us 2,250. Okay, now that we have this, the next thing we need to do is to compare this to the actual overheads, right? So we are saying that we save 2.5, but actually we expected to spend 2.5, but actually we ended up spending 2.5, right? Because the actual overhead per month is 2.5. So it was 2.5 across board, 2.5 across board every month, as stated in the question. So when we look at it, we expected to spend 2.5, but we spent 2.5. Was there any under or over absorption? No, there wasn't. You come here, we expected to spend 2.7, we spent 2.5. It means that this was what? An over absorption, right? We spent less than expected, so we over absorbed by 250, an extra income. And here we expected to spend 2250, we ended up spending 2500, meaning that we have under absorption, which is an additional expense of 250. So now that I have gotten this, I can now establish my statements. So now I'm going to do statement for absorption costing, right? I'm going to bring my statement for absorption costing. So I'm going to do January, February, and then March. Okay. So how then does it work? So I'll start with my sales. I believe sales units were different. So sales, I will take January. So January sales would be my selling price, which was 10 cedis, and then I multiply this 10 cedis by the number of units, which was 1000, and that gives me 10,000 for January. When I go to February, the selling price was still 10 cedis. I multiplied this by the 800 units. I end up with sales of 8,000, not so. Then I come to March, sales still 10 cedis. We sold 1,200 units, and that gives me sales of 12,000. So this is how it works. So we've gotten sales down. I will call this A. Okay. The next thing is to less the cost of sales, right? Cost of sales is actually your cost of production. So I will start with opening stock, right? Opening stock. Now in January, you realize one thing: there was no opening stock. So our opening stock, we have to value our stock by, our stock, we multiply by what? We value it at our it's like our stock times our production cost per unit. And since it's absorption costing, we use the full cost of production. So opening stock, when we come to January, our opening stock was what? January we had 0 stock, but we valued our absorption profit at 6.7, so this will be nil. When we come to February, our opening stock was nil, also at 6.7, so it's nil. But when we come to March, you realize that from our statement in March, when we valued our stock, you realize that in March we had opening stock of 300, so that 6.7 will now be valued at 300. So we take the 300 unit and value it at 6.7 for March, and that is 300 by 6.7, and that's 2010. Then we add production costs. Okay, production costs, because we have already computed the production cost. When we take January we produced 1,000 units, so all the 1,000 units will be valued at the same 6.7. So 6.7 by 1,000, that gives us 6,700 for January. So it's simply the production units, how much you produced, by the cost of production, right, which we calculated. For absorption costing, it was 6.7 because it's full cost. It includes fixed cost already. February, the number of units we produced were 1,001 by the same 6.7. So everything here will be valued by the same 6.7 that we got, and that is 7370 Then March, I guess March we produced 900 units. So 900 units by the same 6.7. So 900 by 6.7, we end up with 60, 30. Okay, so now that we have this, we are now going to deduct our closing stock. So we are going to less closing stock. So closing stock too, we value, right? The same way the stock by the production cost per unit. Now when we go to the unit, it seems that January there was no closing stock. So closing stock 0 by 6.7, there was no closing stock. Okay, now February, was there closing stock? I believe so. We had closing stock of 300, now being valued at 6.7. So the opening stock we had here will now become closing stock here. Of February, was there closing stock? Let's check and see. February, yes, February there was closing stock of that 300 units at 6.7. 300 units at 6.7, and that is 2010. Okay, then we come to March. Was there closing stock? No, there wasn't closing stock. We produced and sold 1002, so this by 6.7, so no closing stock. Okay, so now that we have finished this up, we get our cost of sales. So cost of sales, so our cost of sales will literally be what? Opening stock plus purchases less closing stock. So we have 6,700 being our closing stock because there was no opening, and to be our cost of sales, sorry, we call this B also. And this one we add 7,370 minus 2,010 being our 5,360. Then we have 2010 plus 60/30 giving us 80/40. Okay, so now that we have that, we can get our gross profit. And our gross profit is our A sales minus the B, which was the cost of sales. So this one, the first one, the sales was 10,000, so I take 10,000 minus the 6,700, and that is 3,300. And then I come to 8,000 minus 5,360, so I take 8,000 and I minus 5,360 from it. I end up with 2,640, and then I come to this guy, that's 12,000 minus 80/40, 12,000 minus 80/40, and that is 3,960. Okay, so now that we have gross profit, we need other expenses. So first of all, I will adjust for any under or over absorption, right? Under over absorption, and we realize that the first year there was no the first period there was no under and over absorption, but when we go to the next month there was under absorption, over absorption of 250, which is an income. So I add income of 250 to our gross profit, and this was under absorption, so I take out what? 250 expense. Then I come to what? Operating expenses, which is non-production cost. So operating expenses, I think we had what? First we had variable selling cost. So variable selling cost. So this variable selling cost, because it's variable, it's a percentage of sales. Okay, selling cost, percentage of sales. Since they gave it to us per unit, that means how many units were sold. So January, I believe we sold 1,000 units, so we take the 0.5 per unit times the number of units sold, which was 1,000, just half of 1,000. I believe this will be 500 in January. When we get to February, it's still 0.5 per unit, but February we sold 800 units, and that gives us 400 CDs. Then we come to what? March, 0.5, but we ended up selling 1,002 units, and that is 600 per unit. Then we go to the next expenses. So we had the fixed selling cost, or fixed selling cost, which was actually 600 per month. So 600, 600, 600 for every month. Then we have fixed admin expenses. fixed admin expenses, which were also 900, 900, 900 every month, because they gave us per month. So when I look at all these expenses and I add up, I believe these expenses, I can just straightforward take it out from our gross profit, straightforward, so that I get the profit for each particular month. Okay, so we have 3,300 minus 500 minus 600 minus 900. That gives us 1,003 as our net profit for the very first period. Then we have 2,640 plus over absorption of 250 income minus expense of 100, 600, 900. That gives us 990. Then we have 3,960 being for March minus under absorption of 250 minus expense of 600, 600 and 900, and that gives us 1,610. Okay, so that ends the absorption costing statement. So now the next statement is the marginal costing statement. So for marginal costing, you know, with marginal costing is one of the most important statements for management accounting. So for marginal costing, we go this way: get our sales less all variable costs, get our contribution less all fixed costs, then we arrive as our net profit. Remember this. Okay, so now that we have that, let's just do January, February, and then our March. Okay, so that gives us our statement. You could have done it monthly, but I feel this is obviously straightforward. So we get our sales, and I believe sales, we've already done it. Sales wouldn't change. It will still be our 10,000 that we had before. I believe is by the sales unit, right? This one was 8,000 and that one was 12,000. Okay, so sales, it will still be the same, so I'll just underline it because I'm doing it columnar. I didn't want to bring two columns. Then now we less all variable costs, right? So all variable costs, both production and non-production. So first of all, I'll take production variable cost, right? Production variable cost. So here I'll first start with what my opening stock, and it seems we didn't have any opening stock, but the value of the production cost was worth what? I think it was 4.2. Yes, let's go and check the valuation that we did. Yes, it was 4.2 before we added that 2.5, so it was 4.2. So we value everything at that 4.2. That is how you are going to go about it. So in that case, opening stock, when we come to January, there was no opening stock at 4.2, so it's nil. When we come to February, there was no opening stock, 0, also at 4.2. When it comes to March, there was opening stock of 300 by the same 4.2. So March would be the 300 at 4.2, which is 1,260. Okay, then we come to our production cost. Our production costs, you know, everything will be valued at the same opening stock plus cost of production. So January we produced 1,000 units. Now they will all be valued at 4.2, which gives us 4,200. We come to February we produced 1,100 units, now at 4.2. So 1,001 at 4.2, that gives us 4,620. Then we go to March. We have what? We produced 900 units. So we produced 900 units. So the 900 units at 4.2. So 900 at 4.2. We had 3,780. Okay. So now that we have been able to do that, we now need our closing stock. So closing stock, I believe we have January closing stock. So January there was no closing stock, so 0 by 4.2, nil. What about February? Was there closing stock? Yes, 300. Now it will be valued at 4.2. Take out 300 by 4.2, and that gives us 1260. Then we come to March. Was there any closing stock? No. At 4.2, nil. So now this is closing stock, must be deducted, right? So once we do this, we come and get the total variable cost of production, right? Total variable cost of production. So when we are adding up, this is still 4,200. We do our 4,620 minus 1,260 for the next month, which is February. We end up with 3,360. Come 1,260 plus 3,780. We end up with 5040. Okay, now that we've gotten this total variable cost of production, we need other variable costs. Okay, so we are adding all variable costs. So other variable cost in the question, yes, we add other variable costs, the variable selling cost. So you realize that we had variable selling cost of 0.5 per unit. So variable selling cost. So other variable costs, we have variable selling costs. So variable selling cost, I believe we had variable selling cost of 0.5 per unit. So you just multiply by the sales. It's on sales. So January variable selling cost, we did it in the previous question, the previous statement. We can just pick it up or just work it here. So January variable selling cost of 0.5, but we sold 1,000. So this one gives us 500. We come to February, that's 0.5 per unit, but we produce 1,001 in that period. Hey, but we sold, sorry, that one is based on sales. We sold 800, so that is 400. Then March, we sold 1,002, so half of that, 0.5 units, and that gives us 600. Okay, so now when we put this together, we get our total variable cost, remember. So now that gives us our total variable cost. Okay, total variable cost. And remember that when we sum all our variable costs and deduct from sales, we get contribution, right? So 42 plus 500, that gives us 4,700. Then 3,360 plus 400, that gives us 3,760. We have 5040 plus 600, that gives us 5,640. Now we get our contribution. Let's call this B, right? So we get our contribution, which is sales minus variable cost. So we get our contribution, which is A, sales, minus B, which is the total variable cost. We know the face sales is 10,000. Then we less our 47 from it. That gives us 5,300 as our contribution. The next sales was 8,000. So we less our 3,760 from it. We end up with 4,240. We have 5,640 sales of 12,000, but we take out our 5,640 from it. We end up with 6,360. Now we less all fixed costs, right? So fixed costs, irrespective of whether it's production or non-production. So all fixed costs will be taken out from production, from contribution to arrive at what? Profit. So fixed cost, we will first start with our production fixed cost. And production fixed cost, the question said every month fixed production overhead was 2.5. So we take our 2.5, take our 2.5, take our 2.5 every month, and then we come to our fixed selling cost. When we come to fixed selling was selling cost 600 per month. So 600, 600, 600. Then fixed admin, also fixed cost, fixed administrative cost was also 900, 900, 900. Okay, so these are the total fixed costs. So basically I am going to add up all the fixed costs and let's see what we get. So that is 2,500 plus 600 plus 900. So the fixed cost will be 4,000 each month. So 4,000, 4,000, and 4,000. Also, okay. So that's our total fixed cost. Total fixed costs. So we know that our net profit is this. Let's call this C, right? A minus B equals C, and let's call this D, right? So net profit is C minus D, which is contribution minus fixed cost. So contribution was 5,300 minus fixed cost of 4,000, and that gives us 1,300 because there was no difference in the profit, right? No difference in stock. It will be the same profit both years. Now let's come here. February 4240 minus 4,000, and that gives us 240 profit. Then we have 6,360 minus 4,000 fixed cost. That gives us 2,360 for the last month. Okay, so we've gotten the net profit for each one. Now the next thing that we are mostly required to do in questions is to reconcile the profit. So we are going to do reconciliation of profits, and the reconciliation, all you have to do is just get the OAR by the fixed cost. That will give you the difference. And remember, I told you where closing stock is more than opening stock, absorption costing profit is more than marginal costing profit. So if I do January, I do February, and I do March, I can easily reconcile the profits, right? I can easily reconcile the profits. So I'll start with the absorption costing profit, and because when they are the same, it wouldn't change. So absorption costing profit was 1,300 for January. Let's go and check. This one was 990, this one was 1610. 990 and 1610. This guy was 990, this guy was 1610. Okay, so that was the profit. Now we need to add the change in profit, okay, or less it, because if it is more, that means when closing stock is more. You should understand that. So change in the profit, told you, is just the OAR times the difference in stock. Okay, remember. So when we take January, the OAR we calculated, it was 2.5, right? By the change in stock, there was no stock. It was 0 minus 0, no opening, no closing stock, so it's nil. That means absorption costing profit will be the same as marginal costing profit. When we go to February, the profit was the OAR is still 2.5, but the change in stock, there was no opening stock, but there was closing stock of 300. So their difference in stock is going to be what? 2.5 by 300, and that is 750. Okay, it's going to be 750. So this one is, the change in stock is 750, right, which is a reduction. So if you do 990 minus 750, you should get the profit that we got, which is still 240, right? Now when it comes to March, it's still 2.5 OAR, that's the fixed cost per unit. The change in stock was that there was opening stock of 300, but there wasn't closing stock, right, which will end up becoming what? 250 by the same 300. 2.5 by the same 300 is still the same 750, but this 750 is more, right? It's a positive figure. So if we put it together, marginal costing profit after doing this reconciliation should just be the same. This is 1,003, that is true. This one results in 240. Now 1610 plus 750 is going to give us 2,360. You see, it has actually been recorded. It has actually been reconciled. 2,360, 2,360 correct. 240, 240 correct. 1,313 correct. So that is it.